Every cycle begins the same way, not in the market, in the mind. Before any candle even forms, the mistake has already happened. 2026 arrives with promises, lists, maps, new narratives. Not because the world changed that much, but because people need to believe they did. The more options appear, the more comfortable it feels to be well-informed. And the more comfortable that feeling becomes, the more fragile the decision behind it. There's something almost no one admits. Choosing too much is an elegant way of committing to nothing. The market understands this better than any analyst. It doesn't punish those who make fast mistakes. It exhausts those who change their minds slowly. That's how capital evaporates without a visible failure, not in a collapse, but in a sequence of small abandonments. One position replaced, then another, then one more, always with a good argument, always with a new thesis. Until, without noticing, the investor is no longer building anything, only reacting. Meanwhile, something curious happens outside the spotlight. When the conversation gets too loud, when everyone is searching for the next thing, the market's center of gravity narrows. Fewer assets matter. Fewer decisions truly count. And the game is no longer decided by who discovers something new, but by who stops chasing the new. 2026 won't reward brilliant choices. It will reward eliminated choices. Before talking about coins, strategies, or charts, there's an uncomfortable truth that needs to be clear. The biggest risk isn't choosing wrong. It's being unable to sustain any choice long enough. If you still think this video is about which cryptos to buy, you're looking at the surface, because the real decision happens before that. And once you see it, everything else stops being a debate and becomes a consequence. In every new cycle, the market repeats the same trick. It convinces you that more options mean more opportunity, more narratives, more promises, more charts, more can't-miss coins. At first, it feels like freedom. Over time, it becomes noise. Because the more things compete for your attention, the less clarity you have about what actually matters. 2025 made this painfully clear. There was no shortage of projects. There was a shortage of focus. Many people spent the entire year jumping from thesis to thesis, confusing movement with progress, activity with results. And the market, quietly, did what it always does. It tested who could sustain a decision without constant stimulation. This is where essentialism starts to make sense. Not as a beautiful philosophy, but as a survival mechanism. Because the problem was never choosing too few coins. The problem was trying to follow them all. And while that was happening, something else unfolded in the background. When volume dries up, when hype evaporates, when the market enters that lukewarm state that drives curiosity away, capital doesn't spread out, it concentrates. Not because of ideology, because of efficiency. Liquidity attracts liquidity. Infrastructure attracts infrastructure. And in crypto, that creates an unavoidable effect. Money gravitates toward where risk is lower, and persistence is higher. If 2026 were a test, it wouldn't ask how many coins you know. It would ask how many you can hold. When silence arrives. Because when the market stops talking, when the feed empties, when attention disappears, variety doesn't sustain a portfolio. Structure does. And when you observe where capital leans, every time the noise fades, the map becomes uncomfortably simple. Not because of lack of options, but because of excess reality. That's when the choice stops being about what to buy and becomes about what actually remains. Every market shares one moment in common. The moment when the noise ends. Not the top, not the bottom, but the space between cycles, when no one is excited enough to sell courses and no one is scared enough to run. That's where differences reveal themselves. Projects that depended on attention begin to fade. Roadmaps go quiet, communities shrink, liquidity disappears. And suddenly, very little remains to observe. Bitcoin keeps producing blocks. Every 10 minutes, no pause, no exception. Ethereum keeps settling value. Applications keep running. Contracts keep executing. Fees keep being paid. None of this makes headlines. And that's exactly why it matters. Because the real test isn't fast growth. It's continuity under indifference. Bitcoin doesn't need to prove usefulness every week, and it proves existence. Ethereum doesn't need to convince anyone it's the future. It solves problems that already exist every day. One functions as a mutable monetary ground, the other as a programmable operational layer. Different roles, different pressures. One shared trait. Both were designed to keep functioning. Even when the incentive to pay attention disappears, that changes everything. When the market is euphoric, anything looks promising. When the market is neutral, almost nothing looks necessary. But when risk rises, when capital becomes selective, money doesn't look for new ideas. It looks for a survival record. Not theoretical survival. Practical survival. Code tested under stress. Networks that endured congestion, attacks, failures, criticism, and kept going. That's why, in decisive moments, the market doesn't spread out. It concentrates. Not out of belief, out of pragmatism. Because when you remove every narrative from the table, the remaining question is simple. What still works if I do nothing? Very few answers pass that filter, and the more the market matures, the less room there is for distraction. And the more value exists in structures that don't require constant supervision. That's where essentialism truly begins to make sense. Not as a nice idea, but as a logical response to an environment too complex to monitor all the time. And once you reach this point, the transition is inevitable. If only a few structures survive silence, why complicate the place where the margin for error is highest? Bitcoin and Ethereum don't exist to compete for attention. They exist to fulfill different functions in silence. Bitcoin doesn't try to be fast. It doesn't try to be flexible. It doesn't try to please. It was designed for one thing only: not to fail. Every change is rare. Every adjustment is painfully slow, because any mistake there doesn't cost a quarter. It costs decades. Bitcoin isn't optimized for innovation. It's optimized for survival. Ethereum emerges from a different need. Not to store idle value, but to organize movement. It's where contracts execute, where financial systems are simulated, where errors happen and are corrected. Ethereum embraces complexity because it needs it. It trades rigidity for adaptability, as long as that adaptation follows visible rules. One doesn't replace the other. They complement each other through contrast. Bitcoin is the ground that doesn't move. Ethereum is the system that operates on that ground. And here's the mistake the market has repeated for years: trying to treat both as bets. They don't ask you to be right about the next cycle. They only ask for time. Time for scarcity to take effect. Time for utility to consolidate. Time for excess around them to wear out. While narratives rise and disappear, these two networks keep doing the same thing at the same pace, indifferent to noise. Producing blocks, executing contracts, functioning. That's why, when you look at them honestly, the question changes. It's no longer, which one will go up more? It becomes, which system still makes sense when no one is excited? Most cryptos try to be everything at once. Store of value, platform, bet, promise. Bitcoin accepts being slow. Ethereum accepts being complex. That clarity of role is what keeps them standing, while others disappear without a trace. And once you understand this, investing stops being a game of constant choices and becomes a structural decision, repeated with discipline. In a market addicted to novelty, what protects the most and irritates the most is what keeps working without needing attention. And maybe that's exactly what so many still haven't realized. The market always promises novelty. It always points to the next name, the next chart, the next story. But time doesn't reward those who chase everything. It rewards those who choose well and remain. When you zoom out from the cycle, the price, the feed, something uncomfortable and simple remains. Bitcoin and Ethereum don't ask you to predict the future. They ask you to move through time. Bitcoin exists to remind us that money doesn't need permission, bailouts, or explanations. It doesn't react, it remains. Ethereum exists to show that systems can evolve. Without erasing the past, without hiding rules, without concentrating control. It doesn't promise stability. It promises execution. One stores value, the other moves value. While the market distracts itself with promises, these two networks keep operating, block after block, indifferent to excitement and immune to forgetting. Maybe that's why the hardest decision in crypto isn't choosing the next coin. It's accepting that the basics, when done well, beat complexity that isn't sustained. 2026 doesn't require you to know everything. It requires you not to abandon what makes sense. Because in the end, it's not about how many decisions you make. It's about how many you manage not to make. If this video clarified your perspective, hit like and subscribe to the channel. Here, we don't chase narratives, we build conviction. And now tell me in the comments, which of the two did you accumulate the most in 2025? And why do you believe it still makes sense to carry into 2026? Because in the end, time doesn't respond to promises. It responds to those who remain.